Earlier this week on Squawk Box, ahead of his SPAC beginning to trade, we talked to Pershing Square Capital's Bill Ackman, and he had some pretty interesting words about the model and what it may mean.
We're committing $1 billion, $1.5 billion, possibly more of our own capital. Every investor in a U.S. SPAC has a full right to redeem, meaning if you don't like the deal, you get your money back with interest. So, the idea of a lead investor, looking for throughout the world to find the highest quality, best business on the best terms, negotiating a transaction, committing capital, and only then do investors get presented with the detailed information they need to make a decision, and they have a full opt-out. The typical process, IPO is announced, several days, it's a scramble.
So, Stacey, some people who are fans of the SPAC say effectively it's an indictment of the IPO process. What do you think of that?
I think that investors and companies looking to come public are looking for choices. So their early investors, along with the companies, are looking for alternatives to the IPO process. It's not going to replace the IPO process. But when we talk about IPOs on your show and in other places, and you see it up 60, 80, 100%, that often gets described as a good thing. But it's not a good thing if you're the one that sold it the night before. So what we're seeing is companies saying, I want another way. I want to be public, but I want an alternative to do it. Spotify did it with a direct listing. We've seen other companies follow suit and others interested. We recently filed to innovate with that and add capital raise. SPACs have been such an important part of the capital formation process throughout this first half of the year. We raised over $19 billion in SPACs, and that was actually prior to Bill Ackman. So well over $20 billion in SPAC proceeds in the first half of 2020. Over 85% of the proceeds raised was raised on the New York Stock Exchange because we're seeing a different caliber of business leader looking to take advantage of this mechanism now. So they're coming to us, and I get calls weekly from different business executives saying, hey, I'm launching a SPAC. Can you help me out? So I see it coming. I see it continuing.
I was going to say, though, historically, SPACs had a bad name. I mean, there was a view that it was I said it yesterday, a sort of a compensation model for the sponsor or the manager that was masquerading, if you will, as an investment strategy because the sponsor took so much of the deal. And so the question is, in terms of the cost of doing these things, now some of these models are adjusting a little bit as this matures a bit. But are you worried or concerned about that?
No, frankly, historically, the New York Stock Exchange didn't list SPACs because they didn't meet our listing standards. And the way that they've evolved and the way we've evolved with them allows for large companies to come public. And we've talked a lot about what Bill's doing differently in this particular SPAC. You're going to continue to see innovation on the process, but it provides another path to public, which is a good thing. So those retail investors aren't denied those opportunities to invest in the most exciting and dynamic companies that are coming to market. So we're going to see more of it. We definitely will. I don't think it's going to replace the IPO market, just like I don't think direct listings will replace the IPO market. But those first day pops are frustrating for a lot of companies. SPACs give a little bit more control, and you can negotiate a deal and then come public, and you're public like every other company then.